Welcome. Today we're covering the foundation of financial accounting, the accounting equation. I want to start with a question. Do you really own your car? Take a second to think about that. The answer might be more complex than you think. The answer depends entirely on how you paid for it. In accounting, this relationship is what we call the accounting equation. Let's break it down using that car as our example. Imagine you buy a $30,000 car and pay for it entirely with cash. In this case, you own 100% of that asset. Your equity is equal to the car's value. But what if you don't have $30,000 in cash? Most people use a loan. This introduces a second way to finance an asset, borrowing from a creditor. If you put $6,000 down and take a $24,000 loan, the car is still a $30,000 asset. But now you only own $6,000 of it. The rest belongs to the bank. This is the accounting equation. Assets equals liabilities plus owner's equity. Every asset must be financed by either creditors, owners, or both. It must always balance. So who paid for the asset? Either you, the owner, or a creditor. Remember, assets represent what you have, and the other side shows how you paid for it. Understanding this balance is your first step toward mastering accounting. Head over to the practice problems now to see this equation in action. I'll see it in the next lesson.